Hello, Tony Byrne again of Wealth and Tax Management. I've read many books written by the most successful investors in history, and what they've all got in common, they've all used a system, and using a system has been proven to work every time. The problem with investing is it's very emotional, and if you let your emotions take control, you'll be like the vast majority of people out there, not make any money. So let me just explain how our wealth investment strategy works. It's based on the work of a Nobel Prize winning mathematics professor called Professor Harry Markowitz. He conducted a 38-year study from 1952 to 1990, and he categorised US shares between low risk, medium risk and high risk shares. So he grouped the three, tracked the returns. High risk typically 20% of the total, medium risk 30%, low risk 50%. Typical profile for a medium risk investor. What he showed over the years was that each class of share had different typical returns. So high risk shares could be anywhere between minus 100%, yes, you heard it, minus 100% in a year, to plus 135% total return. Medium risk shares typically made 7% to 13% per annum, and low risk shares typically 3 to 7%. Professor Harry Markowitz's aim was to disprove the theory rather, that you could time the market. In other words, buy when prices are low and sell when prices are high. It's often said that only fools and geniuses can get that kind of timing right. So the way this works is that if you do regular reviews of your investments at least 3 times a year, which is how this works with Professor Harry Markowitz, then you can keep your shape. It's very important to keep your shape, like a football formation, keep your shape. Because if you don't do that, if you don't review once every 3 years, the shape may change into this rectangular shape. So remember, you start off as a medium risk investor with that strategy. By now, after a few years with no reviews, the high, medium and low risk percentages could look something like that. So it becomes from a triangle to a rectangle. The problem is, you've inadvertently become a high risk investor because you got 34% in high risk. Alarm bells should start ringing. The reason this system works so well is because when you have too much in high risk as a percentage of the total, above 20%, that indicates that prices are too high. So you should bank your gains. It's an automatic system that we use to review our clients' portfolios every 3 months. So you bank your gains above 20% in this example, put into low risk. But the opposite is true as well. When you have too much in low risk, that indicates that prices are too cheap. So now's the time to move some money out of the low risk into the high risk. This circular system has proven to work very well. After 38 years of one heck of a long study, Professor Harry Markowitz won the Nobel Prize for Economics. This was the formation of something known as modern portfolio theory. Our system, Wealth Investment Strategy, is totally based on the works of Professor Harry Markowitz and modern portfolio theory, and we've got a very good long-term track record that backs this up.